Hello, everyone. It's 1:30 on October 27th. Great to be here with all of you. Welcome to the latest CalALTs webinar. Today is our Election 2020 series, part 1, what to expect leading up to November 3rd. This is a two-part event. We're going to have a piece of it today, and then we're going to have a piece of it after the election, so we can kind of compare and contrast the panelists' thoughts, investment ideas, and other observations on what is a very interesting time in global markets, given the election that's going on. I'm Jason Gerlach. I'm a member of the CalALTs Board of Directors. I'm a co-founder of the organization. We're happy to be celebrating our 10th year of existence. This is our latest effort to bring together the alternative investment community with thought leadership and idea sharing from some of the brightest minds in alternative investing. Before we get started, I'd just like to acknowledge our platinum partners. You can see the logos here on your screen. Without these great firms, we could not be doing what we're doing. So we thank them all very much, and we ask you to support them. And these are our gold partners. I'll issue the same statement. Thank them, patronize them if you can. They're great firms, and they're the reason we're able to put on the content that we put on. And we really appreciate their support, the platinum member support, the silver member support, et cetera. We have a lot going on at CalALTs. The whole point of it is connecting people who invest in alternatives, who manage alternative strategies, and who service the investors and managers of those strategies. And you can do that in a lot of different ways, not only by joining webinars like today, but getting involved in some of our special interest groups, which are listed here. We have special interest opportunities in real estate, in fintech, in venture capital, in hedge funds. We have a group for next gen, people who have recently joined the industry and are looking to make connections. So there's a lot of different ways you can get involved with CalALTs. So go to calalts.org to learn more about our organization. If you're not a member, sign up. It's a very cost-effective way to better connect yourself to the alternative investment community. And please just get involved. We like to hear from everyone in the industry, whether you're here in California or not, and the more people that get involved, the better off these kind of opportunities will be for everyone. While the attendee videos are off and your audio is muted, I encourage you to submit any questions you might have to the panelists in the Q&A area. We'll do our best to get to those questions. Some questions were sent in already, and we will try and address those and weave those into the content, but please share your questions. And if you have questions that we don't answer, we'll do our best to send you some follow-up information or connect you with the panelists directly so that they can answer questions you might have. So with that, let's bring in my panelists. We have a great group. Here are their photos, and here's a little bit about their firms. I'm going to let them each briefly introduce themselves and talk about what they do, and more importantly, where you can learn more about what they do and follow them, whether it's on Twitter or otherwise. So why don't we go around the horn? Barry, good to see you again. It's been a while. We're happy to have you here. Tell the audience who you are and what you do.
Sure. So my firm is called Ironsides Macroeconomics. I founded it about 1.5 years ago after 35 years of working for big behemoths on the street. I spent 25 years at the combination of Lehman and Barclays through the bitter end and then on to Barclays. I was in the equity derivative business for 1.5 decades. Then I was in principal trading, running a macro book, and then moved into research and was Barclays equity strategist and I suppose sort of the face of Barclays for a time on CNBC and Bloomberg and the like. I left to go effectively become director of research for BlackRock Fundamental Fixed Income. Did that for a couple of years, having been an equity guy my whole career. I don't know, I suppose it wasn't exciting enough for me. Spent 18 months with some ex-Lehman guys at Guggenheim Securities, which is really an investment banking boutique, and then decided to start my own macroeconomic research shop. So my clients are the big institutional clients that were always my clients, hedge funds, but it's broadened out now too. As a smaller business, I can consult with family offices and smaller endowments and even wealth advisors. And so I run through macroeconomic research every week as if I was a portfolio manager, having done that part of the function. It's a little bit differentiated, I think, from the street. So you can find me at Ironsides Macroeconomics. on the internet. Website is https ironsidesmacro.substack.com for the research. I'm on Twitter, not hiding. It's at Barry Knapp. You can find me easily there, and I try and put some ideas and thoughts up there as well. So
great. We're thrilled to have you. We know you're a busy guy, and we appreciate your time. Bryan, please let the audience know what you're doing. Hold on. Unmute. Still muted. Jessica, can we make sure Bryan's unmuted?
You got me?
There you go.
Okay.
Good.
Thanks. Sorry about that.
No worries.
Yeah. So Bryan Goligoski, I run Stillwater Capital, StillCap. I fell into the hedge fund business in 1996, getting a job at Mark Strom's global macro shop in Santa Monica. And I worked on the equity side and had the pleasure / interesting career choice of becoming a short seller. So for one of the greatest bull runs in history, I have focused a decent amount of time on short selling and hedging, which led me to run Nuveen's equity long short strategy back when I worked for Santa Barbara Asset Management. Fund is still in play, and you can look back at the performance. And I've been involved in liquid alts now, going on probably more than a decade. I worked for TCW trying to build a liquid alts business there. I worked for Hatteras Funds, which is a fund of funds. And I started my shop 4 years ago under the idea that let's do liquid alts right, price it right, build it right, et cetera. And so that's what my focus is. Like I said, I'm an equities guy. And so with a dabble a little bit on the debt side as it relates to balance sheet, et cetera. I write a weekly piece, This Week in the Markets, which gets a decent readership and hopefully has some provocative ideas and some ideas in there and talks a lot about markets. I can be reached at Bryan, B-R-Y-A-N, at stillcap.com. And I'm happy to sign anybody up for the weekly commentary. And I'm looking forward to the conversation.
Great. Thanks, Bryan. And lastly, Chris, welcome back to the CalALTs Forum. It's good to have you. Maybe just give people a little brief overview of what you've done and what you're doing.
Sure. I am the Chief Investment Officer and a partner at Sunrise Capital Partners. We are a 40-year-old quantitative hedge fund. We were sort of one of the first in the space to use statistics and computers, in essence, to drive our investment decisions. We have a pretty storied track record, and we've traded through most of the really hairy stuff that the markets have sort of given us an opportunity to see since 1980. Today, we are more focused, I would say, on the short term. We trade largely intraday, and we're long short in the equity indexes sort of around the world, and we've become quite adept at trading volatility as well.
Great, and you're on Twitter, correct?
I am on Twitter. I'm at Stanton CIO, so like Barry, not kidding. And I say some things. I try to say what I can in there without sort of alarming any of the regulators, but there you go. Or drawing Twitter fire generally,
Good. All right. So 3 smart market observers here. Let's dig in. Before we talk about the election specifically and where we're at right now, I think for everyone it'd be great to give some context as to where we've been since Jan 1, because it's been quite a ride. Bryan, why don't you start us off?
In my 20 some odd years in this business, I have never seen a year or even could have postulated about a year like this in terms of going from the closest thing to a liquidity crisis since we had in the fall of 2009 to what can only be described as one of the great liquidity booms, only months later. So if there's ever a market that had tail risk on both the left and the right tail, this was it. And I still try to process what is actually taking place, just because the sheer nature of the Fed getting involved and being involved in the high yield debt markets. I mean, a lot of us, and I'd love the rest of the panel's thoughts on this, a lot of us simply have to get rewired. I think this year has fundamentally changed the face of what we're supposed to be doing for the next decade. So it's a hell of a year. That's all I got to say.
Barry? Unmute.
I muted myself. Sorry, trying to avoid the background noise. The dog it was feeding time for the dog. So anyway, I would echo some of what Bryan said for sure. I mean, I just as an anecdote, a Bloomberg reporter was trying to interview me about the Fed bailing out hedge funds around about April or May. And I said, listen, if that's your headline, you cannot quote me. I said, because the Fed is bailing out their own bad regulatory policy. Policies like having a fixed NAV on government money funds and not on prime money funds drove a massive amount of liquidity out of the private sector to the government-only sector. Having different capital treatment of cash versus government securities basically created the collapse in the treasury basis and mortgage agency basis, right? So when the Fed had to buy all those securities, it was because the regulatory policy, which was meant to push risk outside of the banking system, yeah, it did it, but it pushed it into unlevered entities that couldn't react. And so that's why the basis went crazy. What I also, though, found through that period, while everyone called it unprecedented, from a macroeconomic perspective, it really wasn't all that unprecedented. And I would draw people to 2, maybe 3 recessions that were quite similar in many ways. 1958, we did have a pandemic. GDP dropped 10% in the first quarter of 58. It was a very short recession. We had a sharp snapback. 1980, Jimmy Carter invoked credit controls at the beginning of March of 1980. ISM went from 50 to 29, the manufacturing index, and then straight back to 60 by the time the election came around. By the way, that cost Jimmy Carter the election. So there are some parallels there that you might be able to envision. But again, it was a super short recession, 6 months, and things came snapping right back. And so when the market fell as much as it did, which was more than average, it'll turn out to have a less than average actually earnings decline, because although the magnitude of the GDP drop was greater, the duration was the shortest we've ever had. There was actually precedent. And so, it just created a bit of a roadmap for what to do if you followed out these other recessions. But the liquidity piece of it that Bryan referred to was just fascinating. And I still think it's misunderstood.
Chris.
So what I would say is definitively idiosyncratic to this year would be volatility. What folks maybe should think about a little bit is this. We'll just look at the last 30-day average of implied vol. Last 30-day average of sort of implied vol has sat up in the, if you were to look at the VIX, sort of in the mid to high 20s, right? Like sort of that 27, 28. Today it's sitting at 33 and almost a half. Realized vol over that same period is 17. That means we're trading at 100% premium in the volatility markets. And what that effectively means is what we've seen here is the following. If you look back at 08, at least, what you saw was, vol spiked just as high as it sort of did in February, March of this period, but it returned to, it's a mean reverting instrument typically, right? We generally live in a 15, 16 vol world if you look at it over time. And so what I find particularly interesting is even in that period where they were inventing a lot of the tools they very quickly deployed this year, we mean reverted much faster, right? Sort of at that 6-7 month mark, we were piercing 20 and moving back down to the high teens. We are sitting out here 9 months now above sort of 25. We cannot renormalize volatility. And so what I find sort of interesting about that is that, it's sort of one of these things where even as we've added sort of absolute liquidity in terms of, the fixed income markets and all the things the Fed's done, liquidity is at a premium over on the equity side of the sort of ledger. And so what I find particularly interesting about this year is its inability to drop back below and mean revert in essence. And we understand probably why it's held up here with the, obviously with the election on the horizon and sort of just the timing of when we bounced in March and all those good things. But we are living in a world where the vol market has said is pricing an awful lot of risk in essence, or in terms of sort of expected standard deviation in a daily move. That I think is particularly unique to this year.
Interesting stuff, guys. All right, let's pivot to the election. Obviously, we're all looking at a crystal ball. We don't know what's going to happen a week from now. There's a lot of possibilities. You have models out there talking about blue waves. You have a few idiosyncratic guys out there saying that, the silent Trump voters are just going to overwhelm the polls on election day, and we're going to get a repeat of 2016 and everything in between. Does it matter? Are you looking at it? Do you care? What do you think is going to happen from an election standpoint? Is any of the statistical data out there convincing to you? Bryan, why don't you start us off?
Your point is well taken. The statistical data, the trending all say blue wave. Texas getting close is almost unheard of. So there's all this collage. That said, is that confirmation bias? Do we want this to happen? And so I hold out that, yeah, what you mentioned about, the Trump voters showing up and it not being, what appears to be like something of significance in terms of a shift, I can't get past that. But the collage that I'm seeing says that, yeah, there is some significant change. And I also noticed that of the early voters or of the mail-in voters, that tends to lean Democrat fairly strongly. And so if you're seeing that wave of mail-in votes, that portends good things for Biden in a lot of these close Senate races. So, but again, I need to be careful because confirmation bias of a collage is a dangerous thing.
Barry?
I am very sympathetic to the Trafalgar Group work, which is one of the organizations that is more idiosyncratic and focuses on, they ask the question, who do you think your neighbor is voting for? And it's another version of the shy Trump voter. And I'm sympathetic to that in part because I did a lot of analysis around 2012 and was absolutely sure Mitt Romney was going to win, and he didn't. And it sure didn't look like Donald Trump was going to win in 2016. And Trafalgar Group and John Cahaley nailed it. And he got it again right in 2018 around things like people like Ron DeSantis, which was a similar dynamic. So I'm sympathetic to that. Furthermore, when you think about the way the market's positioned, we had a little bit of a gut check on the Biden blue wave scenario last week. You saw solar stock sell off, wind stock sell off, energy rally, financials rally, and healthcare rally all around about Wednesday, Thursday, as it surrounded the debate. So I think the market was telling you that we may be a little bit offsides on positioning. So take the financial sector, for example. I was negative for more than 10 years. I turned positive in 2017 after the Treasury reform proposal because the regulatory policy is at least as important as the rate environment for financials. Well, if we go to a Biden administration, he puts Lael Brainerd in charge of Treasury or something, and they stuff a whole bunch of capital back in banks and ROE falls back below 10%, the group's going to be dead money. But it's incredibly cheap, right? So if Trump does win, there's huge upside to the bank sector, and there's not very much downside. And, to Chris's point, the skew, is really it's in the 85th percentile, right? So selling downside, buying upside really sets up there. So I'm sympathetic to those outlier calls for those reasons, and partially because the market is a little leaning pretty heavily on the blue wave story. So
what are you seeing, Chris?
Here's what I think. I think so you should ask two questions there. The first, who I think will win. I think notwithstanding the polls, I think Trump's going to win. And I think he's going to win because there's no meaningful dialogue between the parties with respect to issues, right? So the parties have become so polarized that we can't get a sense anymore of you can't get a debate anymore. There's no more active debate. And so I think what's happened is with sort of all the social media shaming and things like that, I think people have gone way underground with their opinions. They just don't share them anymore. There's really no upside to it. So I think the problem is that there's no meaningful way to gauge the polls at all, in my opinion. I mean, this is kind of how I predicted Brexit way back when, I sort of, called that one because, again, you kind of looked at it and you said, I just don't think people are having conversations. So we don't really know where anyone stands. And so really the reason I kind of make that guess is because volatility is staying so high. All right. So because as we'll get to when we talk about this, I think, what it means if Biden wins and what it means if Trump wins. I won't hijack that part of our conversation. But what I'll say is volatility appears to be pricing in a Trump victory because I think the China trade conflict spikes almost immediately after he's reelected. And sort of all heck breaks loose on that front. And so just looking at the sort of money moving through the market, I'm leaning towards, I think Trump may win. That's just what I'm seeing involved.
All right, well, we won't hold you to any of this. Obviously, this is tea leaves, and you'll all have a chance to either brag on the 5th of November or eat crow and explain why you were wrong. So it's good we're doing this. All right, let's jump to this question. Is there anything people should be doing in their portfolios right now with a week to go to the election, or is it too late? Should they have already done it? Brian.
You're talking to a guy who hedges, and I would say if you can and know what instruments to use, I say this is a great time to square off your book. Or if you're a manager, I would say square off your book. The risk of missing a couple hundred basis points on the upside is far smaller than the risk of a decent hole in your portfolio coming into the late year, given everything that has happened. The easy narrative is Trump wins, Biden wins, huge stimulus, worry about taxes later. That would be good for the market, but to what extent? To what extent, given where we've come? Like I said, because I do a lot of hedging, I'd say square off your book, come in with a low net.
Fair. Barry, agree, disagree?
Well, the question I keep getting asked, the media, for example, is, what works under either scenario? And I think there's a couple of compelling stories out there. One in particular is the inflation outlook. And we're going to have stimulus post the election, regardless of whether Trump wins or Biden wins. This is a very different business cycle than 2008, 2009, when Carmen and Vince Reinhart presented an abridged version of Reinhart and Rogoff to the Jackson Hole Symposium in 2010. They looked at 15 post-World War II financial crises, and the most compelling or persistent economic effect was a decade of disinflation. It makes perfect sense. Right back in 2008, 2009, the household sector was at all-time record levels of leverage. So was the financial sector. Neither of those things are true any longer. In fact, financial obligations ratios were updated for the second quarter. The household sector has never had less of an obligation as a percent of disposable income to mortgage interest, overall interest. So that it's evidenced by the housing boom, right? I mean, people are spending money, they're borrowing money. So this is a very different monetary setup than 2008 and 2009. And the single biggest disinflationary factor for 3 decades was core goods prices, right? To Chris's point about the trade war, there wasn't really a good economic argument to manufacture in China to sell in the US since the middle of the last decade. But you've had a series of shocks, right? You had the Great East Japan earthquake and tsunami, Thai floods back in 2011. You had the trade war. Now you've had COVID. We're going to go from just in time delivery to just in case delivery. And that restructuring will cause that disinflationary impulse to dissipate, and inflation's headed higher. So I like the inflation trades. Vol in fixed income is completely suppressed by the Fed taking down a third of the mortgage market. I was thinking about that when Chris was talking about vol in our first segment. So betting on higher rates through vol to me looks like it's a pretty good trade regardless of who wins. So that would be if you don't have it on, that's a pretty good position to have, I think.
What are your thoughts on where portfolios should be right now, Chris?
So it's interesting, Barry sort of nailed it on that one, right? Because that is the key, right? Bond volatility has absolutely been infinitesimally small. Go look at any of the sort of sovereign fixed income, any part of our curve, right? Any part of U.S. Treasuries, 10-year, 30-year, they just don't move anymore. I mean, we moved a point yesterday, and that was a massive move, right? For the full 32 ticks. Look out! I mean, it's really walking in cement. However, what I will tell you statistically is the following. When equity volatility picks up, bond volatility may or may not pick up. When bond volatility picks up, 100% of the time, equity vol goes. I'll say that again. If bond vol explodes, equity vol absolutely explodes. There are no exceptions, period. Just think back to the taper tantrum. So the bottom line is this. If you're looking to weather portfolio volatility, right, on the equity side, there's sort of very little you can do in terms of sort of buying vol, in my opinion, equity vol, because it's already so overpriced. Gold's had its move. Maybe you can buy some yen vol, something like that. And Brian raises a good point, right? The easiest thing to do is, because we're still sort of up near the highs, just take some off, right? Just lighten up your portfolio to the extent you feel comfortable. But if that's not something that's really sort of realistic for you, because you're an institution and you have this sort of unwieldy portfolio, bond vol is a heck of the way to go, because if you buy some and it goes, well, the bottom line is, if it doesn't go, equity vol will probably quiet, right? If you kind of look away. But if fixed income begins to misbehave for any one of a variety of reasons, which we'll get into, then you're going to be okay. You'll be hedged on that side. So bond vol's a pretty good play. I like it. That and maybe yellow.
Before we move too far, in our lead up conversation last week, this group, we got together and Barry brought something up that had me thinking, like, I better up my game and have an interesting take, because, and I'll let you, Barry, I'll hand over some of my time, as it were, but I want you, for the group, at least for me as well, to explain out your theory on what if a Biden win, what happens to Powell and what happens to ZERP. And again, I don't want to speak for you, but that was a very interesting point you brought up, and I think the audience would really like to hear that.
That was Chris.
Yeah, that was my.
Oh, was Chris?
Yeah.
Okay.
Yeah, we'll get to that. We'll get to that. Let me just set it up first, and then we'll go right back to Chris.
Yeah.
So, all right. So we have three scenarios. Everyone seemed to agree on our pre-call. There are three scenarios. There's the Trump win, right? If he wins, it's probably not going to be by a lot. Maybe it is, maybe it isn't. But if he wins, that's one path. The other is Biden wins, and somehow he wins by enough that Trump says, yeah, okay, I concede. And there's kind of an orderly transition. And then there's door number three, which is some kind of close contested election. Maybe it's a Biden win, maybe it's a close Trump win. And we get into a Bush v. Gore 3-month battle for the White House. So those seem to be the three potential scenarios. So starting with Chris, let's talk about kind of the implications of each of those roads for things like the Fed and portfolios, et cetera.
Well, what we were talking about is, I said, look, if Trump wins, it's probably somewhat bullish for a while. And then I think that what Trump means for the market is more volatility. I mean, we all understand that. He hits the tape. He likes to paint the tape. He causes these intraday moves saying no stimulus, raising tariffs, not raising tariffs. His sort of administration likes to hop out on the front lawn of the White House and sort of talk up the market, whether it's, Larry Kudlow or it's, Lighthouse or whomever it is that goes out there and tries to turn the market midday. They like to paint the tape, and that causes a lot of sort of adverse movement in the market. And so there's that. And then there's also the changing of the policy on a dime. We're sort of in a fight with China. We're not. We have a deal. We don't. All that good stuff. But so it's sort of, my view there was, if he wins, he wants low rates. He wants low rates so he can have his fight with China. He will reinitiate the fight. So we'll see like a persistence in this sort of Fed policy. I believe will carry into the first quarter. And then I think volatility wins the day. I think there's more fighting between the White House and Congress, and we roll over. All right. And Barry can articulate, and Brian much better than I, the fundamental reasons why that will happen. But I can tell you statistically, we're getting crowded here. We're seeing price action. And statistically, that leads me to believe we're going to have another sort of 3 sigma correction. Now, if Biden wins, it's interesting because I do think you get some relief in terms of stimulus and that good stuff. But what I said was, I think Powell is history as the Fed chair. One thing we're all sort of counting on is that Fed policy will stay right where it is. It won't change unless there's a material move in inflation. And even then they said that's okay if that overshoots. The problem is, I don't think Jerome Powell's the Fed chair. I think it happens for the following reason. If you look back in time, you can see, Greenspan came in 1987. He was a Reagan appointee, and he obviously had a pretty big run. But in February of 2006, Bush appointed Bernanke and replaced him. And he started this sort of tit for tat process where then, Obama came in, and admittedly, Obama didn't do it until February of 2014. But again, with 2 years left, he replaced, Bernanke with Yellen. And then, Trump came in and he got rid of Yellen, and he said, I want this sort of ultra dove. I want low rates, or whatever his problems were with Janet Yellen. And he sort of replaced her in February of 2018. I think the problem with Powell, when you look at the narrative here, is that the guy's worth, by every estimate, he's a former partner of Carlyle. He's worth $55-60 million. That's a terrible look for the Democrats. I think there's no way they're going to leave him in there. And it's undeniable that the Fed's policy in the last year has affected the largest wealth transfer away from middle class to ultra wealthy in the history of capital markets. That's a fact. If you look at sort of what's happened with Jeff Bezos' wealth, Elon Musk's wealth, when you look at the top tier sort of billionaire crowd, they have absolutely crushed it and benefited materially from this policy. And I just don't think that's going to hold up with the current, sort of Democratic narrative. So I think what's probably likely to happen is you're going to see a narrative emerge where, Powell has a dog in the fight. He has his money in indexes. He benefited from this. He's a rich guy. That whole policy, he was part of that Trump administration. He's got to go. Low rates benefit the rich guy. And I think when you see that rumbling, one way you could see a Fed policy turn for no other reason than political reasons is if that narrative emerges. And if that one emerges, you better have the bond vol that Byron was talking about. Because if you don't, it will be a couple of very sad days in your portfolio.
Barry, follow on that, please, and talk about the three roads we might follow post November 3rd.
Sure. So my perspective on the Biden blue wave is the market will react favorably to it. I generally view elections as breeding optimism in most of the world, quite frankly. But I suspect that there's going to be some significant buyer's remorse when we get into early 2021. And what I mean by that is when you start actually thinking about it and gaming out what they're likely to do. If the first step is a fiscal stimulus plan that's larger than the Republicans want and very untargeted, right? So we reintroduced the $600 expanded unemployment insurance, which the CBO said would slow the recovery in the labor market, disincentivize people from looking for jobs. This is the 2009 playbook, by the way, because the best year for the labor market in the last cycle was in 2014, 5 years after the recovery began. That's when we ended at 99 weeks of extended unemployment benefits, right? The Republicans want an EITC. The Democrats want the $600 of expanded unemployment benefits to go on for some time. Same thing with transfers to state and local governments, that sort of thing. It'll likely get no Republican support like the American Recovery and Reinvestment Act of 2009, which means they'll have to use reconciliation. They have two bites at the apple next year because there was no budget deal this year. It's just a continuing resolution. That will mean later in the year, they'll want to do healthcare and tax hikes to pay for them. And they'll make the tax hikes retroactive, and the market will game this out and say, wait a minute, we're wiping out the Tax Cuts and Jobs Act. Some of you may have seen Paul Tudor Jones on CNBC, although it's kind of early for California last week, where he said, gee, you're going to hit earnings by raising the corporate tax rate and hit the multiple by raising the capital gains rate. That's historically basically true. So I think the first trade out of the gate in a Biden administration will be higher because of stimulus, but then in early 2021, the market will have buyer's remorse and think through, the implications of these plans. The Trump reaction would likely be favorable because it will mean the corporate tax rate will remain in place. Tax Cuts and Jobs Act did spur a software investment boom. Everyone looks at equipment. There was no real benefit to equipment from the Tax Cuts and Jobs Act. We already had 50% bonus depreciation at a 35% annualized rate. So going to 21% rate with immediate 100% expensing for assets that depreciate over a 3 to 5 year life was no change, no boom, but it created a big boom in software. But I'm very sympathetic to Chris's point. Trump he could have simply done the Tax Cuts and Jobs Act, forgotten about the trade war, sat on his couch and watched Fox and Friends till the election. And if it hadn't been for the pandemic, he would have won in a landslide, right? So he probably will want to do something, and restarting the trade war could be an issue. So both governments could definitely shoot themselves in the foot as we get into 2021. And I think that's a likely scenario. As far as the contested election scenario, Bush-Gore lasted about a month, but we were headed into recession. So I think it would there's no big epiphany by saying, yeah, it'll likely cause more realized inflation. Maybe Chris has realized we'll reach his implieds for a time. But I do think, though, because this is the earlier stages of a business cycle and one that's continued to surprise on the upside, I don't think we'll get the same level of reaction that we got in late 2000. So that's my perspective on those three scenarios.
Brian, what do you think about the three lanes that are ahead of us? What are the implications of each?
Right. So the Biden scenario has been pretty well flogged. The Trump scenario, as these guys have mentioned, does get interesting because we have not had China and trade war anywhere near the front page of the paper in a long time. And that drove, was obviously driving things for a while there. Contested a month and a half ago, I would say, yeah, there's a possibility. But again, if I'm going to collage together what looks to be the case, I think that if the scenario is a decent sized win by Biden, I think that the contested goes away. I think McConnell probably looks at him and says, look, for the good of the country, let's just call this one because you mathematically can't get there. It's a possibility. I don't know. But that kind of dovetails with the blue wave scenario. More importantly, and this comes from a perspective of looking down field a little bit further, as Chris mentioned about wealth transfer, if I ever see the Fed sponsor a symposium about fixing the wage gap and the wealth gap, I will go and I will hang a nice gentle sign and I will protest because they've ceded their seat at that table with ZIRP and with these policies and things like that. And I get the benefit is that the greater economy is held together. I'm looking for what the boogeyman is down the road. And we talked about this a little bit in our call. Inflation is the boogeyman that simply will not boogie, right? And it's supposed to. Everything says it's supposed to, but it won't. We have deficits down the road. We don't have an ability to pay for them. We've got asset inflation. We have all these things that remove that put in the back seat what the next few months are going to look like vis-a-vis. And so when it comes to the idea of buyer's remorse or a hangover, that's what we look for when we hedge, right? Because we're not running a long only book. So we're always looking to say, when is it going to come home to roost? And so I guess my scenario or my thoughts are 2020 will be the anomaly to end all anomalies. 2021 is where you actually finally get some serious digestion of this and a recount of this is not sustainable. So that's loosely a punt, but I think there are other elephants out there to be chased down. So,
all right, good stuff. Let's go through some specific matters that may or may not be affected by the election. The talk of most of CNBC's headlines over the last couple of weeks has been the stimulus. Is there going to be another stimulus? How big is it going to be? When's it going to be passed? Does it matter? Where are we on the stimulus thing? Barry, why don't you start us off on that?
Sure. Well, there's going to be a stimulus. I'd say the bid ask on that is a trillion and a quarter at 2.5. In the scenario where Trump is elected, and or let's put it this way, maybe the smallest stimulus would actually be Biden winning with a Republican Senate and him just getting over the line, but not capturing the Senate. And that's a pretty plausible scenario. In that case, you'd be towards that low end. The blue wave scenario, obviously, you're on the high end. So there will be more stimulus, but the nature of the stimulus is crucial. And I spoke to this, so I'll try not to be redundant, but just on unemployment, for example, there's earned income tax credits that Republicans and supply siders, this is in essence a supply side or Hayek argument versus a Keynes argument, right? I mean, do you stimulate the supply side or the demand side? Republicans want earned income tax credits to incentivize people to go back to work. Democrats want Keynesian demand stimulus, send everyone checks, although Trump wants that too, so he doesn't really fit into all this. Or the expanded $600 per week, which is the playbook from 2009 and could slow the recovery, sending money to state and local governments. Those are all sorts of things that will matter a lot. So to me, it's not just the number, and I spoke about this on CNBC actually, where they were saying, well, we're close on the number. I said, you're not close on the structure of it. So that structure is really what's important for me. And that,
Chris, any thoughts on stimulus?
To Brian's point, that will matter a lot for how things trade, and how things develop next year, right? Because that's when you start paying for all this stuff.
Stimulus, Chris, anything of note in your mind?
the probability is it goes through one way or the other way. It's just a function of, I think structurally it matters, as Barry highlighted. I think duration matters, depending upon how they, again, that's just another structure point. But I think you can handicap it at a pretty good shot unless something miraculous happened on the vaccine front. I mean, that's your only sort of offset. If something miraculous happens on the vaccine side, I don't know that it nullifies the necessity for stimulus, but it kind of maybe decreases the argument a tiny bit to the extent, because everyone can kind of maybe go back to work and restaurants can open a little more at full force and things like that. The sectors hit the hardest.
Brian, the way I see it is one of the many interesting things about the Trump administration has been they've spent legendarily. Now, obviously, you can argue there's been a reason to, maybe there isn't, whatever, maybe spending deficits don't matter, as a lot of Republicans like to say now. It seems to me in either case, we're looking at a lot of spending, whether it's on stimulus, maybe there's infrastructure. What do you see, Brian?
As I said a few times on this subject, the rarest bird in Washington is the deficit hawk.
Yeah.
And the Republicans have for sure moved well off that position, because it's one of the easiest things to move down and have it not affect your 6-year term in the Senate or your 2-year revolver in the House. Just nobody's looking at it. Jeff Gundlach does a good job of pointing this out. And the nice thing I like about how he explains it is this is going to be a problem, but it's not going to be a problem for a few years. And that's the truth. Also, if you start to get higher rates, imagine what that does for refinancing debt. So it's going to come. It's just like inflation. It's just one of those things that it's on the radar, but it's not anywhere near close to final approach. One thing I want to step back and mention about stimulus, and this is a frustration of a fundamental manager, is the signals that are out there in AI are far faster than my ability to pick up on what the next trade is for this month, this week, or what have you. It's very frustrating because the markets, to a small extent or to a large extent, are gamed. If you look at some of the work that's out there, if the stimulus checks go through, you will see a pickup in transactions. Those pickup in transactions will be captured by the algorithms. The algorithms will trade on that and will drive stocks higher. That will happen. And it's a quantitative trade, not a fundamental trade. It's an interesting place to be in. There's a ton of great work out there. Bloomberg has done some really good stories about a professor out of Harvard named Chetty, who has done some amazing work because his data set is that good. And that's tough from a fundamental perspective, saying, look at the problems underneath. No, it's going to trade higher on stimulus. It's my opinion.
Chris, tying some of the points we've all made before together, it sounds like in either scenario, we're looking at a lot more spending. How the money's spent will vary, but there's going to be stimulus. Maybe there's an infrastructure on top of that. It sounds like we have trade war redux if Trump's reelected. What happens with China in a Biden scenario? Does that just go away as an issue, and we're back to kind of 10 years ago policy, or what happens there?
My best guess is if Biden wins, I think he drops the tariff sort of war pretty quickly. And if he does that, you better be long, because the equity markets will run on that. You need to remember something. Trump's setup was, hey, pal, give me zero rates so I can go after China, right? He was doing that all last August, right? 2019 August, right? That was his thing. He was like, hey, cut rates. He should be cutting them to zero so I can tariff them. And no matter what they do to us, we're going to be in good shape. In essence, we may manufacture a meaningful GDP hit, but zero rates will offset that. And now he has that. Now he's got his zero rates. Now he's got, the sort of Fed out there quantitatively easing, right? And on the bid in high yield debt. So, the setup is there to have this fight and just have it be volatile. It doesn't necessarily need to crush the market because he's got the backdrop he wants. Now, what he also has is COVID, which is sort of decimated travel and, dining and all that. And so that's its own headache. But there's sort of the fact of the matter is, I don't think Biden exacerbates that problem. I mean, I think he can walk it back. I think he starts by probably saying, we're going to take these tariffs off, you take yours off, and let's go back to a table and do this sort of more diplomatically, right? Through the WTO and things. I think we go into a repair mode there, image-wise, and my guess is the tariffs come off. And I think the market would bump from it.
All right, Barry, just looking at this hodgepodge of potential things out there that we've discussed. where does COVID fit in all of this? Obviously, the disease is not gone. The cure is not yet here. There's obviously a raging debate about how governments should deal with it, ranging from do nothing and just let everyone get sick to, lock down everyone forever. Obviously, what's going to happen is somewhere in between. Where do you see COVID policy going in the various scenarios, and how does that affect all of the markets that we've been discussing, or does it affect them at all?
Yeah, I don't think it's all that big a factor for the markets any longer, in part because when you get hit by the same shock, when you get hit the first time, obviously it's a massive shock. When you get hit the second time, right? We had a shock in March, February, March. Then we had another one with the Sunbelt wave in the summer. And, it caused a consolidation. But then when you looked at the rate of change of new cases, that peaked at the end of June, and then cyclical stocks took off and the market rallied hard. We're having a third wave now. I suppose you could attribute yesterday to that. I don't. I think yesterday's downtrade had more to do with election-related concerns. But I also don't think that dispersion is that great between the Great Barrington Declaration or focused protection that's going on in Florida and Phil Murphy going on CNBC saying, I can't shut everything down anymore. I can't do it on a statewide basis. Maybe we'll have to do it in a town. So I think that range of how you deal with it from a macro policy perspective has narrowed a lot. So I just don't see it as I think it's more politics at this point than it is actual economics. Okay. There is the consumer behavior piece of it, but that's, if you're just talking about the policy piece of it, I don't think the range of outcomes is very different.
All right. Before we start talking about specific sectors that we like or don't like in these various scenarios, just any other geopolitical type issues that we haven't hit on. We've talked about inflation. We've talked about potential Fed policy changes, COVID, infrastructure, US, China. Is there something out there that we're not thinking about? Middle East, Russia, LATAM, Bryan, anything?
I think we've hit most of the big points. Russia's been quiet for so long. You've seen what oil has done. You've seen the kind of the quasi destabilization. If there's gonna be a problem in Saudi Arabia, would have happened by now. So, but to your point, yeah, it's looking again for the boogeyman. That it's very elusive. There's the other boogeymen out there are very elusive.
Chris, anything?
Yeah, there are two more landmines that folks need to start thinking about. Okay. So the first I said was change in Fed policy, because all of a sudden we talk about gutting the sort of board, the voting members. All right. The second thing people need to start thinking about is, so because rates are so low and because the Fed jumped on the bid and yield in corporate debt, they've effected a change in the 60-40 portfolio. Big institutions are now moving out of sovereign debt in the 40 piece, right? So 60% equities, 40% bonds. That bond cheap piece is turning into corporate debt. They're chasing yield, right? Because it's perceived as being less volatile. What you need to understand is if you do that to your portfolio, you're changing the inherent volatility profile, right? Because you're running a 15 vol on the 60 side, and the 40 side, you're no longer running the very low vol that Barry pointed out, like 2, right? You're instead now bleeding in high yield debt, which presumably will exhibit high yield debt like volatility. So you're changing personality. So that's one issue I'd keep my eye on. It just means that if the Fed says we're not on the bid anymore in corporate debt, brace yourselves, because your portfolios have a lot more vol in them than you thought. And I think that's happening on an institutional level. And the second thing is, I would say this: pay very close attention to the reality that we have crossed the magic meridian in the fact that more dollars are now managed passively than actively. And what that means is that when you move to passive investors, what it in effect does is it decreases marginal liquidity. And the reason it does it is because they don't run any of their money in cash. You understand? Passive investment, by definition, is indexing your money. So as you do that, there's less liquidity available on the downside to cushion the moves. I think that's another piece of vol ratcheting higher. So just understand that when we move through that meridian, as we move for each dollar that moves out of active and into passive, you're also very likely, there's good math behind this, decreasing liquidity in essence, right? Because that downside cash doesn't deploy into pullbacks anymore. It just rides the lightning. Those are the two big ones that are sort of just landmines planted out there, waiting to sort of detonate in corrections. It won't collapse the market, but it will make rides more volatile. That's all.
Chris, I have one small question to follow up on and short answer before you get to Barry. How does the Fed get off the bid in high yield? How do they do that? How do they articulate it? And this is what's messing me up is I don't know how you get off this stuff.
I'd be honest with you. You're asking the $1 million question, right? Or we'll call it like the $1 trillion question. I have no idea. I don't understand how that headline hits the tape and everyone doesn't go, uh-oh, right? I mean, think about like credit default swaps, right? I mean, do you need them anymore in your portfolio? Like, you know what I mean? So for stuff that's like AAA rated and, you know, whatever, like the really good stuff, right? Because, well, can they really default if the Fed is just going to kind of run in and support them? There's all sorts of skew in the vol profile of that market. I don't know. If you come off that, I honestly think that the long end of the curve will steepen at an alarming rate. That's what I think will happen. I mean, you know, because you're just going to be like, how do I get short? How do I get short fixed income in any kind of duration, right? That's a great question. I have no idea. That's a terrifying headline, by the way. Even the remember like the taper tantrum. Just remember that. All he said is, we're going to stop buying and start this and blah, blah, blah. And it was like 3 handles down in the bond market by the time he stopped talking.
All right, we have about 10 minutes left, guys. So let's take everything we've discussed and talk about action items. Where should money be flowing in the next year or two for whether you're a family office or an institution? You know, should they still be in a 60-40 position or 60-40 dead because of the things you discussed? Should they be, are there particular sectors people should be looking for? Should they start migrating to more alternatives or private investments, you know, private equity, venture? What do you think, Barry? Start us off. What are the good investors listening today? What should they be doing?
Yeah, I have a lot of sympathy for what Chris was starting to describe about how it's unlikely that the bond portion of your 60-40 will really act as an effective diversifier. In fact, I made a call this summer that after earnings season, we would likely have a drawdown of roughly 10%. And I suggested sticking with cyclical exposure because we're in the early stages of a business cycle, but raising cash, not deploying the money in the bond market. And I still think that's true. Just a little point of clarity around all this is the way that the Fed is suppressing bond volatility is pretty clear. And you'll see as they start unwinding it, what happens. By buying more than 1/3 of the outstanding agency MBS market, the single biggest source of volatility in fixed income is mortgage prepayment risk, right? Prior to the crisis, when the bond market rallied, rates fell, vol went bid. That correlation has completely flipped. Now the Fed drove both rates down and vol down because the Fed doesn't hedge volatility, right? They buy those mortgages and don't hedge them. Fannie and Freddie hedged them, right? They owned $1 trillion each. They hedged it. So if the Fed decides that they've made the mortgage market not function properly, the agency MBS market not function properly, and we may very well have a restructuring of the GSEs next year. That's probably on the table, regardless of the election outcome. Then, you know, the Fed could start pulling back from those mortgage purchases, and that's when you'll start to see bond vol move. So, you know, that's from a broader asset allocation perspective. I don't think having treasuries in your portfolio is going to be a particularly effective hedge. From a more of an equity market perspective, one of the things we haven't talked about here is, and I know Chris has got the view that the trade war will restart, and it probably will, but it's a second shock, not a first shock for me. And so if you look at global trade and global growth, from mid-2018 to the end of 2019 was the first period since China was integrated into global supply chains where global trade contracted and global growth was positive. So we have very depressed inventories around the world. What's also happened over the last 10 years is that the global supply of safe assets is almost entirely dollar denominated, which the reason the yield curve inverted in the summer of 2019 was because we were in a global trade and manufacturing recession, not because the US was going in recession, because all those countries that were struggling with that, export mercantilist economies, Germany, Japan, Korea, China, you know, were reacting to that. And furthermore, the global supply of trade credit is now dollar denominated too. So that's actually changed the fundamental relationship for a place like Mexico. Previously, if the peso went down, their exports were more competitive. and they'd sell more. Now they get their trade credit cut off. And so if the dollar goes down, they get more credit and Mexican exports go up, right? It's counterintuitive. So for me, the weakening of the dollar, the recovery that we're in the midst of, all of this liquidity that's being created by the Fed, the extra borrowing means that you could likely have a very sharp recovery in global trade and manufacturing. Places like Mexico, Korea, Taiwan could be the big beneficiaries of that. And that's something I would definitely have some exposure to over the next 6 to 9 months, regardless who's president. Maybe if Chris is right and we get an easing of the trade war pressures with Biden, then it'll work even better in that scenario. But I think it's going to work either way.
Interesting. Brian, big picture, next couple of years, what should people be moving towards? What should they be moving away from?
As my Jewish uncle Isidore said, it's alternatives, I tell you.
Yeah.
I think 60-40 is just busted. I think, I know we're talking our books here, but honestly, with where the Fed is telling you to push out to and the opportunities and the things that are out there, I think alternatives across the board is a good place to be. And I think, and we used to talk about this a lot at Hatteras. I think, in this environment, you can go down market and your average high net worth investor can start looking a lot like Yale, pretty easily. So I joke about my uncle Isidore, but I think alternatives is where you want to be, liquid, illiquid. I think it'll provide the ride you want. So, Chris,
couple takeaways for our investors who might be tuned in today.
Look, I think I think it's very important that folks don't fall in love with gold up here and commodities. They've had a meaningful run. I don't think put your eggs in the sovereign debt basket, like Barry said. The yields, you're not being paid to hold the risk now, right? I mean, all of the risk is skewed to the downside. Each incremental tick up comes with a disproportionate amount of risk to the downside. So like I said, any number of things can go wrong there, frankly. And then the last thing is, boy, I got to tell you, and none of us talked about this, but we'll just say this. Statistically, we take apart data. That's all we do over here. We don't, and we don't look at sort of necessarily fundamental stuff. We look at price action, volumes, things like that. The move into Facebook, Amazon, Apple, Google, Netflix and Microsoft is terrifying. And I mean, just terrifying from a one-way price action, inflation to the indexes perspective. I mean, you look at those moves and you say to yourself, we all know, like, you can look at Amazon. Amazon has a bad day. The indexes just are overwhelmed by it. It doesn't matter. I mean, they cannot carry the tone. And it's sort of like, when I look at risks sort of out there in the world, I hate the fact that a Democratic Congress just essentially said Facebook, Amazon, and Google are monopolists, and we're going to go after them for antitrust violations. I mean, that's a headline that kind of came and went. I looked at it and I was like, well, we know that they're going after Google for sure, but they labeled all of them monopolists. And that, to me, again, with the blue wave coming in, is another thing where I just kind of like, all right, what could go wrong, right? Huge concentration of risk, huge concentration of sort of position sizing, a decrease in liquidity from this movement, all of it levered, by the way, through options. And you can feel that, of course, in skew. And, the wrong headline hitting the tape. So to me, it's, I don't know, maybe hedge a little XLC or K, just a little bit, just in case, just for laughs.
I agree with you on the horsemen. I think the horsemen and their influence and everything, it's mind blowing. And if that changes and if that antitrust comes in, forget the indexes, it's dead money.
Yeah. I mean, look, it's a bubble, right? I mean, everyone hates the word because no one knows how far big it gets, right? I mean, it can turn into a gigantic, it could 4X from here. I have no way of fundamentally telling anybody where the top is. What I can tell you is when you have the amount of parabolic movement, what tends to happen is a reversionary correction that is outsized. It matches the move up, right? And so it becomes disproportionate in its sort of expression of volatility to the downside. That's all. So it'll be scary. It won't mean that it won't turn around and come back, but it will mean that it will scare the living daylights out of you when it comes.
I'd like to add a couple of comments on this. I've done a lot of work and written quite a bit about it. First of all, I'm sympathetic to the antitrust concerns. I do think the process has begun to move from consumerism which was started by Robert Bork back in the late 70s and is how we measure antitrust risk, back to structuralism, right, which is the basis of breaking up the Standard Oil Trust and AT&T, the idea that if you're that large, untoward things can happen. So that process will take place. But more importantly, that the tech sector massively outperformed in the 90s, didn't in the 2000s, did in the 10s. What I would be watching for is saturation in growth in the cloud, just as one example. So when we go from the companies that are the producers of tech, the benefits of that start to accrue to the producer or the consumers of the tech, right? It's already happening in retail, but it's going to, and so in consumer, but it's going to happen in healthcare. We're going to drive technology through healthcare. Healthcare margins peaked at 6.5%, the tech sector at 20.5%, right? Same thing with the industrial sector. They're going to integrate technology to a much greater extent. So the cloud providers are going to become more like cable providers through the course of this decade. And when you see that rate of change of growth in the cloud start to slow, these stocks will stop working, and those benefits will start to accrue. So I don't think tech gets the big 10-year outperformance like it did in the 10s or the 90s. And that's why, right? It's just more broad secular. We had a boom in cloud investment last cycle. It's still going on, but it's getting close to saturation point. So that's how I would think about that, big tech platform. And one final comment, by the way, when I watched Social Dilemma, which was awesome, the one missing piece of Social Dilemma is what these companies did for small businesses. And people should note, small business employment has retraced 60% of the declines since the crisis versus large businesses only 40%. We had the biggest increase in new business formations in history this year, right? And people just started businesses using these platforms. So as much as Social Dilemma is like a big scary flick, and by the way, when Facebook had the boycott, and Starbucks and everybody else virtue signaled and said, we're out, they went, who cares? We're making all our money off the little guys. So,
right.
There's another side to the story too, but anyway, that's it for.
No, that's a good point.
Interesting stuff, guys. All right, we're at 2:30, so we've gone an hour. I think we've touched on all the questions that came in one way or another. If anyone feels like they didn't get their question answered, I would urge you to hit these guys up. Barry and Chris are on Twitter. Brian and all the other guys are all on LinkedIn. They've given you their information about their respective firms. They have research to share with you and ideas to share with you. And we'll be back on November 5th to see what actually happened and see who was right and who might have been a little off in their projections, and then figure out what we do from there. So, gentlemen, I thank you all very much. This was fantastic and just what the CalALTs audience was looking for. And we look forward to speaking to you on the 5th. For those of you who want to see what else is coming up on the CalALTs agenda, please visit calalts.org. Join us, become a member, look at our LinkedIn feed, look at our Twitter feed, and stay up to date. We have a lot of interesting events coming up. We have a lot of groups you can join and a lot of ways you can engage, even during the pandemic, with others in the alternatives industry, both here in California and beyond. So with that, I thank everyone, and we will see you in a little over a week. Stay safe, stay healthy, and don't forget to vote.